made. It may sound cliched, but the fact is that the world has become a global village. So much so, people and businesses are interdependent and interconnected. So problems like a terror attack or earthquake or tsunami, or for that matter, change of a government can have ripple effect across the world. In other words, these changes could have collateral damages. Given this stark reality, how do you manage risk in today's globalized world? That's a talking point. Gentlemen, welcome to the show. Okay, if I may begin with you, Mr. Divasha. SR Group is into all the major sectors.
Right.
But today, ISIS attack in Paris or Boko Haram in Nigeria is a reality. At least 54 countries are battling that problem. These events are disrupting supply chains, destabilizing business and economies the world over. So how do you stay in control of your business in this kind of situation? And also I want to add, ironically, these events negate the concept of just-in-time manufacturing or outsourcing.
We do business in different parts of the world, so we get into what is called a detailed risk assessment to see in that particular region what are the risks which will affect us, which we call the core perceived risks. Okay. And then we try to find various solutions. Okay. Today, the insurance industry offers a very wide variety of solutions, and we try to, depending on the risk, insure against those risks. For example, where we find the focus is on terrorism, we will see that we get into an in-depth analysis and take a detailed terrorism cover. If we are worried about a political event, we'll take a political risk cover.
Okay.
If we are worried about credit risk in a particular country, where they're changing laws, geopolitical situations, then we would be focusing on credit risk. So we got, doing business in different parts of the world, right from countries like the US, Canada, to Africa, to India, to Indonesia. What we realize is that each country offers its own challenges, and what we do is do a detailed risk study. As we go along, I will expand further on this.
Okay. Quick comment from you, Mr. Mantri.
See, from our perspective, this is the growing reality. I mean, a classic example, if I have to put through, is the 2011 Thailand floods.
Yeah.
I think everyone who believed in outsource, Ravi would have stepped out to do sourcing from Bangkok and that area where the floods took place. And no one in the world thought that will have disruption which will hit across the globe. In that particular aftermath, auto industry like Honda's major got impacted, Intel got impacted, Apple got impacted because they had supplies. 14,000 businesses got impacted, 1,400 plants got shut down, and for months together. I think there's a clear case of disruption. Can you actually plan for it to the limit? No, you just can't. But can you manage it? Yes, you can manage it. The multiple risks which my colleague also put across, which probably comes across few very critical sectors if you speak of, we can talk about economic risk, environmental risk, there's a geopolitical, there's a big one which is technological, and also the one last is societal risk. There are all this combination. You could probably analyze each one of them, but the intermingling of a technological risk actually can lead to a geopolitical risk. If there's a cyber attack happening, there's a WikiLeaks taking place, stuff like this, there's enough and more this. I think what's very relevant and important is we need to co-create a shared view with all the multiple stakeholders and get those experts to do the job. Like we from insurance sector, as you rightly said, have multiple covers. But the penetrations actually remains low, and the main reason for the penetration remaining low is, in all possibly human tendency says that anything which is low frequency, which can lead to high impact, people end up not covering it because they believe it's like probably Thailand flood was 1 in 40 years. It never happened.
Flood 1 in 100 years.
1 in 100 years. So how do you? So
how do you anticipate such events, or how you make yourself prepared for all this thing?
Yes, absolutely. As my colleague said, you got to analyze it, see how the basic infrastructure is, see how the core support is. There are multiple factors which have to converge for you to make a plan, and then yes, more importantly, the plan should not be here and now. In the event of that happening, how do you cover it?
Mr. Walaji, your first thought on that?
If I look at it purely from a corporate point of view, in terms of how realistically they can handle it, clearly these are signs that some of the assessments that one does on the political side or on the economic side, those have to be sharpened in a significant way. So in markets where you want to be and where you don't want to be. So there are clearly markets which are much more riskier today as compared to the markets which are much more preferable. So one has to be really comfortable where you want to set up your operations, where you want to have your supply chain management. The other, I think the important point that comes to the fore is that there is a need for diversification. So you clearly need diversity in your supply chain.
The insurance company look at all these factors.
100%. So our analysis is very comprehensive, and that is the reason why you get multiple covers available. When he speaks about diversity, effectively what he's saying is, again, you're taking an insurance. There's a price on which diversity will come, right? The moment you buy everything from one supplier, you get economies of scale and probably you get much better pricing. But the moment you choose to diversify, you're spreading your risk to that extent. But you should be willing to factor the price to manage your business.
Mithun, your comment from a consultant.
If I look at the risks that you're highlighting, I mean, frankly speaking, some of these risks are a very low likelihood. Yeah. So if you would ask me, did anybody in Chennai prepare for the floods? I would say no. They could have taken the insurance policies, etc. In some cases not. But I think the bigger thing to deal with some of these eventualities that are happening at a geopolitical level or at a natural calamities level is that how effective are you when you're responding to this crisis? So I would say that it would be very difficult for most organizations to prepare for anything like this in advance, or to say something which happens in 1 in 100 years or 1 in 40 years. I think preparation for that in advance is extremely difficult.
So natural disaster is a problem. Somewhere like man-made, like like a climate change is a man-made actually in that sense.
Yeah. And what needs to be done is, how do you have a response team, or what kind of a crisis response do you have to actually manage something that is first important part is that you save lives of the communities you're present in, and obviously the employees that are there. And secondly, how do you manage the entire event so that there's no business disruption that you have? So it requires that piece within an organization which can get up and which can be your top team to actually go and get organizations out of a particular crisis. Okay. Because I mean, no matter what kind of risk management you do, it's difficult to predict things like this. But it's
not relatively. This is a reality you're saying. You have to live with this kind of risk. Yeah.
No, but
you have to respond to these risks.
Yeah, but we can always make what is called a DMP, a disaster management plan.
Okay.
That's one part of it. Now, taking the cue from what my co-panelists are saying, for example, in our call center business, in the US, we know quite frequently there are storms. And we have seen an entire call center getting wiped out.
Okay.
So what we do is we have a contingency plan whereby we ensure that we are ready to move the whole business of the call center to another call center. You see, because we got 17, say, in the US. Now, if we got 17 in the US and one particular state is affected or one or two particular call centers are affected, we have got a plan in place to immediately link the other call centers. Okay. So that's one way we try to mitigate it, and that's how we show the insurers as to how ready we are for them to be comfortable accepting our risk. The other point which he said, suppose there is a disruption at the supplier's place or at the customer's end, how do we in insurance deal with it? So I'm getting into a bit more specific and technical.
Okay.
What we do is what we call a supplier's or a customer's extension is available in the insurance industry now. As I said, the insurance industry globally, Ravi, has really grown now. And we can get a variety of covers. So, if I know that there are a few key suppliers on which I'm dependent on, like it happens with my refinery, I ensure that I take a special cover for them. So, God forbid, if anything happens there, there's a natural or man-made, I'm covered, because if there's a disruption there, my loss of profits get covered. Okay? So, there are covers available which is called the customers and suppliers extension.
Okay.
Of course, then it again falls back on my colleague to reimburse me.
Yeah.
But
Hey, Sanjeev, what was your experience in Chennai actually? Because I thought the insurance company lost something like 2,000 crore and the economic loss something 15,000 crore.
Yes. Yeah. So clearly the numbers are mere conjectures, but the loss has been enormous, and there are two losses typically. One is the financial loss, another the humongous loss that the individuals or the collectively the society is going through in Chennai, where they've been suddenly faced with a situation which was so unexpected and so sudden. Clearly, in terms of we as a country, if I have to put things in perspective, and I think I would probably agree with this, our penetration on general insurance itself is very low. We are probably 0.8% of the GDP. There has been some movements over the last few months where a lot of thing has been put across, where schemes have been attached.
The penetration is very low. You're talking about corporate insurance,
I'm
corporate
talking
cover?
general, the country itself, we are 0.8%,
Yeah.
whereas any other developed country or reasonably evolved country you look at will go to 3% to 4%. So we are on the general insurance side very, very low. And a lot of it can at times get linked to the purchasing power, and there is a correlation. I must put this caveat that as purchasing power of countries increase, the general penetration of general insurance across this globe keeps increasing. So naturally there will be a gap. But the fundamental challenge that comes is, look at agriculture. It is subjected to in this country. We are so much dependent on that. So much of our population more than anything else dependent. But still most of the farmers don't end up taking this insurance. And the schemes are available. The general awareness, the ability to penetrate itself is lacking. And as he rightly said, you can't prepare for everything because the probability is low. But there are options available, which our colleague here has right now mentioned. And you have specific details. You have so much knowledge available thanks to the clear penetration of information, which is humongous, that decent cover is available to mitigate your losses.
Well,
but whether you are willing to pay a price is the factor that comes in place. At times we do end up being penny wise and pound foolish.
So let me ask you one directly from an insurance company's perspective. How often do you review your client's portfolio?
It's a perpetual exercise. So any insurance cover, if you see, typically comes for a year.
Okay.
And when you have that year option, yearly renewal comes place, at that time complete analysis of the corporate portfolio is done. There's a clear analysis of what sort of claims were made, what mitigants they have taken, what practices. Like SR has such a phenomenal practice where they end up analyzing every possible angle before they step in. That helps us also to piggyback on what they have done. Plus there itself globally, you'll find there's a reinsurance market which is very significant, which also provides very decent knowledge of whether they want to deal with this particular aspect of a cover which is available in a particular country for a particular nature. So there's enough and more intelligence that is available. It has to be converted and suited to the requirement of the corporate or the individual.
Okay, let me get Mr. Vaidyanathan in. Market volatility is a reality. We are seeing high degree of volatility across asset classes, be it capital markets, currencies or commodities. Oil prices fallen from $100 to $40 per barrel. This is like a moving goalpost. It's a challenge for every CEO and CRO. So how do you survive and thrive in these kind of situations?
If you look at financial markets, whether it's foreign exchange market, equity markets, money market, and now including commodity markets, volatility is the new norm. It's tempting and easy to say that hedging is the solution. Hedging gives you time. So hedging allows you time to revisit your business model. The long-term solution is in looking at your business model. For example, if you are an import-dependent company, right, for raw materials, and you're selling it into a local market where you don't have pricing power, you can take a 6-month hedge on your commodity imports, you can take a 1-year hedge on your commodity imports. But you can't take a lifelong hedge. You need to come back and look at your business model and say, what is the alternate model in front of me to be able to either improve my pricing power or achieve enough margin through volumes? If I can come up with the model through technology, through operating efficiency, to change value proposition for consumers, then I have a game. So I think the important lesson by looking at market volatility is, yes, banks would be very happy to kind of present hedge as a solution, but hedge simply gives you time. What you need is a long-term solution, which is revisiting your business model and making it on firmer footing.
Let's talk about reputational risk actually. It's a new risk. We saw what happened in the case of Maggi. Earlier it was Cadbury's and Coke. So what kind of mitigation strategy should be put in place to avoid such kind of situation? Or is it possible to put any kind of mitigation strategy at all?
It will depend from company to company. And what the names of the companies you just mentioned, if you see the way they have handled it, we have to give it to them, they handle it well. For example, Maggi was off the shelf for quite some time. But if you see the numbers of Nestle, when it comes to, it hardly got impacted, whether it was a share price or the revenues, etc. And you know, the new CEO which has come in, the way he has now given a positive impact to the whole thing. And what happens is that if the ban is only specific to a particular country or a few states, I don't think it creates that much of a reputation risk. But when you see something like the well-known brands today, we have the German car brands, the emission problems which have come in.
Volkswagen, $18 billion they have to pay the US government for emission.
Yeah, so now that is a worldwide phenomenon. Now that is really going to impact their bottom line. But what we saw in case of Maggie, it being country specific and even from the country
point of view, across all the Southeast Asia, they went to Singapore, they went all over the world.
But there nobody banned it. Singapore and all said it was safe. So
then we also started.
So in a way, it got a rubber stamp that it was safe and one could eat more Maggie.
Okay, let me get Mr. Vaidyanathan in.
Reputation risk is something that we take exceptionally seriously. How does one address reputation risk? There is a preventive mechanism and a curative mechanism. The preventive mechanism is good governance. Does the organization walk the talk of good governance? Do you have systems and processes and controls that encourage people to speak up, that encourage whistleblowers, that allow people to stand up and say, I don't agree? There is a popular saying that good news travels very fast, but bad news doesn't. So how does an organization create enough pipes for bad news to flow up the system so that management can respond to it? So that's the preventive or the proactive part of it. The reactive part of it is how quickly can an A-team, a task force come around to assess what the issue is, consider what are the things that we need to do and go about doing them. So you need to have an empowered team that takes charge and delivers on this. Reputation risk is going to come to play as consumer protection across the world increases. So organizations at the end of the day are nothing beyond their brand. So great emphasis has to be made on this. A starting point would be to list out what are the brand values. What does this brand represent to the consumer, to all stakeholders? And then build a governance mechanism which encourages people to live the brand philosophy. There is no shortcut to it. There is no silver bullet solution. It's a lot of hard work. It's about orientating people into brand values, organization culture, for building those kind of Fort Knox solutions for this.
The power of social media and its ill effect in the form of online rumors. We saw a run on the bank some time back actually. So how do you deal with this new menace, and what kind of advice an insurance company would give to your clients also?
No, I think this is a new area which is evolving, and I think it's obviously very scary in the way it kind of picks up whenever it does. I think what's critical in this sense is that how do you use this data to kind of make meaningful decisions, and I think that's where I think the role of some of these analysis like the big data analysis will probably come into play, where you want to collate all that information that's available. What are people really saying in the social media? Is that something which is impacting the underlying credit from an insurance point of view or even from a lending point of view? And we as creditors or as insurers, can we use that information to really make meaningful decisions? Is this something which is impactful in that sense? So it does have an impact for sure, but the question is how do we use that data and make meaningful decisions out of it? That's, I think, where big data analytics is.
But what about political risk? A new government comes to power and there's a policy changes or the reversal of the policy. So how do you deal with this kind of policy changes? Is the government political risk?
It is called political risk, and more corporates who are doing business internationally, especially in certain countries which are politically unstable. And this more, Ravi, from the point of view of the financiers, the lenders, they are very particular that depending on the country, they will insist with the corporate that they should take a political risk cover. These sort of covers, which for a few years back were unheard of, today are become a reality and are more frequently sought after by large corporates, especially you are doing international business, transnational corporates.
Okay.
You see, so what today there are covers available like political risk cover, which is a really broad spectrum. You see, and they cover many things. So if there is a change in the government policies, laws which affect a corporate, they can be covered under insurance.
There are external risk and internal risk. So how do you prepare the organization, as they say in Boy Scout, for any eventualities? Be ready.
As we were just discussing, it is more and more that you get external advisors in-house, you give the CRO his rightful place, and focus more and more rather than living in your own world thinking that this will not hit me, because you don't know what can hit you. So, these are, when you talk of external and internal risk, yes, we need to seriously, have a team of people, core people within each group or corporate, seriously analyzing all the time, and it's a dynamic situation. You cannot say, I had a meeting this month, so the next meeting will be after 6 months. It's a dynamic situation, and people need to regularly meet, regularly need to review, and regularly need to put systems in place.
Mr. Valecha?
Risk management has to be a tool for strategic advantage. It has to provide you really a competitive positioning in the market. So as long as you focus on that area, provide that importance to a risk function within the organization, managing some of these internal and external risks is obviously, you're probably much better prepared in that sense. And also to ensure that your focus is always on the long term and not on the short term. So yes, you will have short term blips, but as your focus remains on the long term, you will be able to tide over those short term mismatches as well.
Okay, final word to Mr. Mantri.
The risk which is stated is far more evolved, far more detailed, far more extensive in current scenario, but so are the coverages that are available to it. There are options available whereby an evolved corporate or an evolved individual can actually take care of the needs in a multiple way. There is a clear need in today's scenario because of the multiple variety of risk individually as well as on a combined basis can inflict pain on each one of us at corporate level or individual level, that there is a co-shared view that is created and there is enough exchange of data and intelligence happening across so that we also are able to see a higher penetration in these particular aspects.
Very well put. Gentlemen, that's all the time we have for this show. Thanks a lot for being on the show. Thank you very much.
Focus, ideate, innovate, enable.